and welcome to our latest Insider interview. Today in the studio, I have with me Gervais Williams, who is fund manager of the Diverse Income Trust. Gervais, good to see you today.
Thank you very much for inviting me in.
So Gervais, I wanted to start off by asking about performance. So on a 3 and a 5 year view, the trust has underperformed the average UK equity investment trust in terms of its share price total return. So could you explain why that's happened?
Yes, I mean, the nature of returns is that actually it's partly income, good and growing income. And actually, if you look back to 5 years ago, the time of COVID or just before COVID, what we saw in the UK market was actually, we saw dividend cuts. Shell is now paying a lesser dividend than it did 5 years ago. So the UK has actually not grown its income very well. Actually, interesting enough, the portfolio has done perfectly well. The companies have succeeded, the income's come through, the trust itself has generated good and growing income over the last 5 years. So generally, that's been absolutely fine. What we have seen is valuations come under massive pressure. And what we've seen, particularly 3 years ago and subsequently, is actually many local investors, many wealth managers have actually taken capital out of the UK to participate in the terrific performance in the US. And it's not just that they put more money into a company which is doing well in the US, but taking money out of the UK has depressed their share prices. The FTSE 100 companies have held up pretty well. These are generating surplus cash. They're able to buy back their shares. Their share price valuations have come under a bit of pressure relative to the US, but they've still generated a reasonable return. Many of the smaller quoted companies, which are actually investing in their business, aren't in a position to buy back their shares. In many cases, even as they succeed, their share prices have been drifting. And in those companies which have actually successfully exceeded expectations, their share price might have gone up, but nothing like as much. So if you look under the bonnet, yes, the fund has actually generated less return over the last 3 and 5 years than many of those which specialise in the very largest companies. But actually, if you look at the underlying health and the underlying opportunity in terms of how well they've done over the last 5 years, actually, I would argue the Diverse Income Trust portfolio has done just as well as theirs. It just hasn't been shown in share prices as yet.
However, in terms of the 1 year return, the trust is ahead by 7 percentage points. Could you talk us through the reasons why, and could you highlight some stock examples that have been key contributors to performance?
Yes, what's been interesting about the last 12 months is small companies have stopped going down. They've not gone up. The AIM market is still down over the last 12 months. Some of the mid-cap index is slightly up, but generally they've just stopped going down. So all that's happened really is the portfolio hasn't changed very much. There are a couple of new holdings, a couple of holdings we've taken profits on, but generally, actually, the portfolio hasn't changed. And because there's less pressure, these share prices driving down, actually, the performance has come through. What's amazing is actually it's not just kept up with the main market, it's actually produced a better return than the main market, which actually says that even without small caps actually having a period of performance catch-up, which they're sure to do at some stage, it's amazing. So coming back to it, yes, I mean, take Galliford, for example, mainstream construction business, 3 years ago its market cap was it was below its net cash balance. It had more cash on the balance sheet making profits than it did in market cap. Strangely enough, over the last 3 years, and particularly last year, it's traded very well. The share price is now around 400 million market cap. So that's come through very happily. We've seen quite a few companies which have been coming through, not just keeping up, but slightly outperforming. U Group, which is a utility business, again, we've seen that starting to come through. We think there's plenty left. And actually, some of the mainstream stocks have actually done okay too. So it's actually been generally many mainstream companies done pretty well. Some mid-sized companies probably dominated the returns, things like XPS Pensions, which has actually went nowhere for several years. Big acquisition, did really well. And what's been happening in the last 3 years, the share price has more than doubled. So coming back, yes, there's some mid-sized companies coming through. A lot of the small companies haven't really moved as much, but it's just a few mid-sized companies have generated that performance. We think there's lots more to come.
You mentioned there's not been too many changes to the portfolio, but there have been some new names. Could you talk us through some of those most recent purchases?
Yeah, so example, take UK Wind, which is a Greencoat Wind. So basically, this is a company which is obviously involved in wind turbines. The share price was actually very much clattered over the last 3 years because people worried about the industry. But actually, the company's done perfectly well. It's generating plenty of income. The income has grown very happily. The valuations come all the way down. That's exactly. It's a mainstream company. It's about 3 billion market cap, actually. But, you do get anomalies in some of these areas. We also actually, take profits on we've had a couple of bids here and there. But generally, all we've needed to do is just top up our existing holdings. Hardly need to change the portfolio at all.
You mentioned Greencoat UK Wind. Is that the only renewable energy infrastructure trust that you own or you've bought?
That's right. We actually don't have many. To be honest, we're not against them, but actually they don't generate the surplus cash we look for as a whole, as a cornerstone thing. So yes, that one is doing so. Most of the others, they're fine, but they actually don't have as much upside. So actually we're much more involved often in industrial businesses, manufacturing businesses, financial businesses. Actually, the areas which have done extremely well have actually been things like some of the mining companies. As you know, the gold price has been very strong. Pan-African Resources, for example, which is one of the leading gold mines in South Africa, it's generated a lot more cash now because, of course, the gold it's drilling out of the ground is now worth 60% more, whatever, than a year and a half ago. So from that point of view, actually, it's generated lots of cash. So some of the mining companies come through. Even some of the energy companies have actually started to produce a return. Energy price comes down, but it's starting to go back up again. So actually, it's been the wide range of companies which have come right, rather than one or two specifics.
We're recording this interview towards the start of a new year. So could you talk us through the outlook for UK dividends in 2025? And are there certain sectors that you view as being more dependable than others?
Yes, I mean, the main thing about the future is we think the range of outcomes is very wide. We've just got Trump coming into office. We don't know the policy is going to apply, but more importantly, we don't know the unexpected side effects, the unexpected setbacks which might come along with that. And of course, we don't know how other countries are going to react. If he does impose, all sorts of tariffs, then they may have obviously their own tariffs to put against it. So we think the range of outcomes is extremely wide. On the other hand, inflation has been up there, interest rates have been up there. There is an expectation of interest rate cuts. Again, we don't know quite how quickly that's going to come through, not just because inflation may not come down as fast as expected, but governments themselves are actually looking to spend quite a large amount of money, not just in the US, but also UK and other global economies. So we think there's a really unsettled year coming up. We think global growth will be hard to persist at these levels. We may see slowdown in the US. Clearly, it's already quite weak in Europe. China's not growing much. UK's flat. So coming back to it, we think it's going to be an unsettled period. The big question we don't know is how much profit margins are going to come under pressure. At the moment, global profit margins around the world have been sensational over the last 30 years. We're near record levels, and we can kind of work out what's going to happen. They may level off for a while, they may go even a tiny bit higher, but over the next 3 or 5 years, we think profit margins are going to come under extreme pressure. So how do companies hold on to profit when some of their competitors are cutting prices? And that's where service levels come in. When we select companies for the portfolio, we look for companies which aren't just good, but outstanding in service levels. So if they are just outstanding, hopefully they hold on to their customers. Hopefully they don't have margin pressure. They can hold on to profitability and cash generation at a time when others are losing out. That means that one, they get a competitive advantage, but two, they are able to invest in their business when others aren't, and you get a disproportionate advantage going forward. We think the world's going to get very unsettled. We think good and growing income is going to get quite difficult, but those companies which don't just succeed but outperform will generate disproportionate returns. Specifically, we think it's a period when picking the winners from the losers is going to get important, i.e. active management. We think indexation has been a great way to make money. That's all about participating in markets. But if markets are more unsettled, they don't go up much. And if you find stocks which can grow up even when the market's not going up, then it's that added value which we think is going to become important. We think the diverse income trust is superbly positioned for that.
And just to ask you a further question on the point that you just made regarding index funds and ETFs. So we've seen for a number of years now, a lot of investors go into global index funds or global ETFs and US index funds and ETFs, and they've done very well out of it. So how would you convince an investor to back the UK and to back a UK active fund manager like yourself?
Well, we know it's been great, and let's be honest, we don't know what's going to happen this year. Maybe things will be even better than they were last year. The Magnificent Seven rose 70% or something like it last year. Extraordinary. Are they going to do another 70% this year? I don't know. It's possible. I don't think it's likely, but it's possible, right? But the nightmare is that at some stage that the excitement's going to get past and it'll peak out just like in 22, and it won't just come down. It could come down a long way. So a lot of clients are actually holding a lot of stock-specific risk. Individual companies are becoming a more significant part of their portfolio. And if you do get disappointments in stock specifics, you can lose a lot of money really fast. It also got a sort of sector bias towards US technology, the mega caps, and so if you find that for whatever reason something which happens to them, so you've got correlation risk. you've got stock-specific risk, and it's just a good idea to not just put it all on one type of holding. And so coming back, the great advantage about the UK market isn't just it's overlooked, it's cheap, but more importantly, it produces most of its income, most of its return via income, cash income. So, if you want to take profits on some of your US technology stocks, great, but you need to buy well and sell well. It's a very transactionally led, good and growing income. You sit back on your sofa like you, and basically you get your income every 3 months, and then you get another one. And so you just get this income just coming in all the time. And if markets are unsettled and you want to buy something more with your income, perhaps the share prices are low, you can add. So coming back to it, we think the return is going to be important. Characteristics, it's not just about transactionally capital gain, good and growing income. We think it's going to become horribly important, not just to private investors, but actually global investors, and that's going to drive. And as that starts to come through, valuations start to come through, then you get the momentum in the UK. The UK outperformed the US stock market dramatically between 1965 and 1985. We've all forgotten. It can happen. We think that pattern's going to happen again. So we think it's a good time to just take a little bit of risk off on those very successful holdings and bring it back to the UK, so that as the pattern changes, you're ready for the next step.
Are you a buyer of the UK? Do you have skin in the game in diverse income trusts?
You bet I do. I've been buying more companies, not just in diverse, all of my clients' holdings. I don't invest directly in the companies themselves. I just buy the funds. It's a great advantage because then I know what's in it, of course. But more importantly, I think, as you know, I'm very upbeat about the potential for the UK to outperform, not just versus, other global markets, but even the US market. And specifically, I think we're coming from an overlooked, undervalued position. So I think there's a bit more catch up. I think small companies specifically, I think there's too much bigness in most clients' portfolios. I think small caps can, run around the feet of the majors when there's an uncertainty. I think the small cap sector, particularly where they make acquisitions from distressed insolvent companies. We saw HSBC make an acquisition of SVB UK, the Silicon Valley Bank. They paid £1 for that. What did it add to them? 5 billion? Now, they were 160 billion already. Fine, every 5 billion is worth having. But if you're a small cap, say a billion market cap, you make an acquisition which adds 500 million, then that's great news. If you're a 200 million pound company, you make an acquisition which adds an uplift of 200 million over 2 or 3 years, that's even better. So the advantage is going to be in smallness, the advantage is going to be in the UK, the advantage is going to be good and growing income. I'm more upbeat now than I've been for 30 years.
Gervais, thank you for your time today.
Thank you very much. I really enjoyed it.
So that's it for our latest Insider interview. Hope you've enjoyed it. You can let us know what you think, you can comment, and for more videos in the series, do hit that subscribe button. And hopefully, I'll see you again next time.